thank you for joining us here this afternoon. We're going to spend between 30 to 40 minutes talking you through some of our views on equity markets, fixed income markets, what that's kind of meant from a portfolio perspective, and a sort of a little bit of a look ahead as to what we can expect in the somewhat slightly crazy world that we're all living and operating within. So we've tried to make this a little bit more dynamic. We've got a few more members of the team speaking who are going to sort of pop up at various points throughout this presentation. So we've got Adrian, James, Mikhail and Max, who are going to be talking you through macro environment, fixed income markets. So just before we kick on to the macro environment, just in terms of a little bit on the performance front, it's kind of difficult to talk this through without putting some of this into context. So what we have been doing is partly sitting on the sidelines for a lot of our portfolios. We've seen markets change significantly over the last 3 or 4 months in terms of size of decline, size of rally, interest rate cuts, stimulus packages announced left, right and center. So we've seen quite a lot of skews coming into play in the market. From our perspective as absolute return investors, that's meant that a lot of what we have been doing is watching, learning and trying to understand what we're taking exposure to rather than trying to chase the market higher and lower. So looking at some of our performance for the last month of May for our dollar model, and I'm looking here at sort of dollar balanced of 61 basis points in comparison to the ARC Private Client Index, so sort of a peer group comparison. The ARC Private Client Index coming in at 210 basis points, 2.1%. So we're lagging behind the peer group on a month basis just because we've got a lot less equity exposure and are more cautiously positioned. If I flick that through onto year-to-date performance, you start to see some of the differences with the performance of our dollar and sterling models positive across the board in comparison to the peer group, and that's essentially because we didn't have as much of the downside, having had a lot less exposure to equities over the course of some of the recent market declines. So in terms of how that's filtering through into our current portfolio allocations, before we sort of get into some of the nitty-gritty, you can see over the course of the last month, our cash and cash equivalents allocation has decreased slightly from just under 30% to just over 23%. That's been half reallocated into equities sitting in the satellites bucket, and the other portion has been put into a little bit more government bonds for protection. Our cash equivalents is primarily also now consisting of short-dated investment grade bonds, because the cash yields and government yields have gone to such incredibly low levels given some of the interest rate changes that we have seen over the last rolling 3 months. So this is where we are currently sitting, just to sort of from an indicative perspective and how we're looking at things. Our equity allocation of, call it 10% as at the end of the month, versus our sort of neutral strategic asset allocation. So we're about a quarter on from a risk perspective. Some of the challenges and what we're going to be talking you through is looking at, how do we justify allocating into fixed income or into equities in the current environment, and how this is starting to feed back from a challenges perspective when we are looking at how we want to invest clients' money over the not just the next 2 to 3 months, but over the next 2 to 5 years. So in case there are any questions on anything that we've seen performance-wise, I'm not anticipating any as we're only just getting warmed up. I will ask James to magically appear on our presentation and start to talk you through, there he is right on cue, some of the overviews from the macro side. James, over to you.
Thank you very much, Simon. The string of unprecedented events in this market is continuing. I continue to regret not having trademarked the term unprecedented. So we've seen the sharpest economic contraction in modern history, and it now appears that there's a possibility that it's going to be the shortest. We've had the swiftest equity market collapse in history, And there's some speculation that it's going to be followed by one of the fastest recoveries. And to round it all out, we have the biggest peacetime fiscal stimulus since World War II, as well as the biggest monetary injection in the history of the post-war era. So it probably shouldn't come as a surprise that the non-farm payrolls report last Friday was also one of the biggest forecasting misses ever. The consensus had expected a decline in payrolls of about 8 million, and we actually got an increase in the payrolls number of about 2.5 million. So you should bear in mind that this is for a time series which before this year had hardly ever gone beyond a range of plus or minus 500,000. So the markets were trying to forecast something which was probably unforecastable, and they missed by a mile. The bottom line is we're off the map. We know that the laws of nature still apply, but economic relationships do not have the force of law, and they are very nonlinear. So it's a classic example of a chaotic system where far from equilibrium, and the path to a new equilibrium is very difficult to predict. So the takeaway here is move cautiously. This is not the time for recklessness, and anybody who says they are confident in this environment is demonstrating their ignorance. There's one thing we do know. We are poorer as a planet today than we were 6 months ago. So imagine it's just you living on an island, the canonical Robinson Crusoe economy. Actually, let's pretend it's you and your accountant. We'll call your accountant the stock market. So you live on this island and you've suddenly become gravely ill. And instead of working and producing, you've no choice, but you're living off your stockpile of seeds. You start to recover from your illness. Of course, you now have less than when you first took ill. You've been eating, but not planting or sowing, reaping or sowing. When you talk to your accountant, the stock market, they tell you that actually you're still worth as much as you were before you took sick. So we have less, but we're worth as much as before. How does this make sense? I'm going to focus my conversation this month on the US markets. And this is because the data out of the US tends to be of high quality and timeliness. It's because the US is about a quarter of the world's economy. And perhaps most importantly, it's because the US is almost half of the world's market capitalization. And right now, that's where the story is, at least for the moment. So let's start by thinking about what the stock market thinks the US economy is worth. So this first chart that I'm showing you is the S&P 500 price to nominal GDP ratio. So this is similar to the price earnings ratio that we often see reported, but it's slightly broader. And the reason I like this is because it's somewhat more robust to the various adjustments that people like to make. And it's because GDP is fairly well understood and is thus forecastable. So the forecast that I'm using here is actually it's a survey of professional forecasters as reported by the Philly Fed. I've not tried to forecast GDP right now. And you can see here that after the dot-com bubble burst in just before 2000, there was a modest but steady appreciation in the multiple until the GFC hit, the global financial crisis hit. Then the market collapsed again, and then it started to appreciate steadily. First, supported by quantitative easing, and then by tax cuts in the US, and tax cuts are quite important. So if we just assume that the S&P 500, the numerator, moves sideways at current levels for the next 18 months, it doesn't go down, it doesn't go up, it just goes sideways at 3206 on the screens right now. Then the blow to the economy, which is the denominator, as forecasted by the survey I've described, well, that denominator is going to go down. So that will push the stock market's valuation, the ratio of the economy, to above the dot-com era peak. And it's going to keep us there even as GDP starts to rise and to catch up. So in other words, not only have we somehow avoided the repricing lower that we saw in the aftermath of the global financial crisis, but instead we're keeping the valuations that have been first boosted by quantitative easing and then by tax cuts over the past almost 10 years, despite the sharp reduction in income and wealth. If I could see the next slide, please, Simon. Thank you. So this is a bit of a mystery. It's a bit of a quandary. Earnings projections currently have an extremely wide variation, and this is unsurprising. Companies themselves have, to a great extent, declined to issue guidance. So how do we think about earnings on in this current environment? So there's an extremely strong relationship between the business cycle, and here I'm measuring it going back to 1960 by year-over-year growth in industrial production in the US and trailing earnings. So typically, we would see that trailing earnings would move about 3 times as far up or down in year-over-year terms as industrial production. So if this relationship continues to hold, we should expect trailing earnings to fall by about 40% year over year, given the sharp decline that we've already seen in industrial production. This assumes that the damage has already been done and there's nothing worse to come. In that case, the stock market would have to move down by the same proportion just to keep the PE ratio constant. And of course, what we're looking at right now is a stock market that hasn't moved down anymore. We're basically back to where we were when we started the year. So earnings, if you believe the relationship that earnings have typically had with industrial production in the business cycle, seem almost certain to go down, but the stock market hasn't budged. So part of the answer might be in how the market is valuing the future. The Shiller cyclically adjusted price earnings ratio adjusts the price earnings ratio by taking a 10-year retrospective view, and he chooses 10-year, it's 10 years because it covers a full business cycle, and adjusting for inflation. So these are some of the adjustments that I was mentioning before when I was looking at it from a nominal GDP perspective. So this makes it a bit more stable, and it suggests that the market could have more room for the multiple to expand. Right now, we're currently sitting at 30.3 on the Shiller cyclically adjusted price earnings ratio. So that's just a bit below where we were in January 2018, which was the prior sort of recent peak, but it's still quite a bit below the dot-com bubble peak of 44. So I'm not showing you the full series here because of limitations of space, but I want to point out that the dot-com peak in this measure was the highest since 1880, which is where Professor Shiller's data starts. And the next highest was 1929, which is just slightly above where we are today. So one possible story that the markets might have right now in their mind is that they think that this blow to earnings is going to be very, very brief. So industrial production has fallen sharply, but it's not going to be a long-term blow to earnings, and thus it's not going to have a really dramatic effect on the earnings ratio that gets extended through time. That inflation is going to remain subdued, and that the multiple expansion, this is probably the most important point, has the dot-com level as a precedent. So maybe 45 is back on people's radar screens. So I think these are pretty heroic assumptions, to say the least. Under the best case scenario, the market is targeting very bubbly valuations, dot-com era valuations, the highest recorded in history. Now, unemployment levels are still at eye-watering levels, even with the positive surprise that came out of last Friday's non-farm payrolls. We're still looking at unemployment on the order of 13+%, which is Great Depression level kind of numbers. Unemployment tends to be very sticky. So there's a technical name for this called hysteresis. And it takes time for people to recover from unemployment, for people to go back to work. And there's a very direct relationship between unemployment and bankruptcies, defaults. And it makes a lot of sense. If people aren't working, companies aren't seeing customers walk through their doors, bills aren't getting paid. So if we're going to avoid this economic blow from having a sustained impact on earnings, you have to assume that this dramatic surge in unemployment just reverses on a dime, has no impact on commercial viability, and that we don't see a large increase in bankruptcies and defaults, which I'm showing here with the commercial bank loan charge-off rates. Like I said, I think that's a fairly heroic set of assumptions that people are making. So there is an explanation for this. When people stopped working and companies stopped owning, governments stepped in to keep demand afloat via deficit spending. We estimate that the global public sector cyclically adjusted deficit this year is going to be around 4 percentage points of GDP. So that means that governments have spent and added about 4 percentage points worth of demand to the global GDP. And that's about a third higher than the peak during the global financial crisis a decade ago. And it's the highest since World War II. So central banks have stepped in to provide liquidity to enable this government spending. But this puts the central bankers in a bind. American consumers recognize that their current situation is dire, but they're far more optimistic about the future. So on the left-hand side, I show you a chart which shows consumer confidence, future less present expectations. And as bad as Americans realize their current environment is, the delta, the difference with the future is huge. And historically, this has been an extremely good predictor of the steepness of the yield curve, which here I'm using the 2s to 10s. So all you really need to explain the recent steepening that we've seen in the yield curve is actually just this change in expectations. And if anything, the yield curve should have steepened much more dramatically already, basis the previous relationship. So here's the conundrum for the Fed. Higher long-dated yields are going to constrain consumer and corporate borrowings for things like houses and for capital expenditures. But they also need to keep the front end of the curve near zero in order to allow the US government to roll over its debt and thus to avoid seeing interest payments just mushroom, balloon. So on top of that, you already have real interest rates, which I'm showing on the right-hand side of the screen, which are already negative, very negative, and thus very, very stimulative. So here's the problem that the Fed has to sort of deal with. They need to keep liquidity plentiful so that they can avoid that kind of systemic seizure in the financial markets. They need to flatten the yield curve so that the back end of the curve doesn't go up. They need to keep the overall level of interest rates low, and they need to avoid inflationary pressures getting out of control. This is a topic that I've actually spoken quite frequently, almost daily, with my colleague, Adrian, who's in the conversation today. So Simon, I wonder if maybe you could ask Adrian to pop his head up.
Yeah, hi James.
Hi, how are you? So
good. You're talking about all the things I was going to be talking about here as well.
Well, that's why I wanted to kind of pull you in here, because I've sort of introduced this Fed problem from the economic perspective. How are they going to manage the shape of the yield curve and the level of the yield curve and real interest rates and liquidity provision, which they absolutely have to, given the sort of economic bind that we find ourselves in. And I wanted to sort of open it up and let you have a crack at expressing an opinion.
Yeah, sure. I think if we can move on to the fixed income slides. If you look at the first slide that I have here, this is sort of showing the issuance of US debt. And the one thing that's been noticeable is that whilst the build-up in longer dated treasuries has been pretty consistent, I would say, growing the same pace as before the crisis, we've actually seen the T-bills doubling up. And the reason for this is it's actually the cheapest point on the curve for the US government to finance. With rates now at zero, they're now getting T-bills less than 20 basis points for 1 year. You know what? It's not really going to add anything to their interest expense. But it does raise a problem for the Fed, as you sort of mentioned. It means, can they really raise rates without increasing the interest expense? I'll come back to that later, because what we're also noticing is that debt is not a problem just for the Fed to concern itself with on a government level, but also on a corporate level. If we go to our next slide, what we're seeing is that this year, to use James's term, the amount of new issuance in, this is investment grade, is unprecedented. We've already hit over 1 trillion worth of bonds issued. This is from the big corporates, the names like Amazon, for example. They only just this year, about a week ago or 2 weeks ago, issued 10 billion worth of debt. You know, they initially wanted 7 billion, but a strong enough demand, they went for 10. They've now increased their debt to 30 billion.
I just want to reinforce what you're saying, Adrian, because I was looking at some numbers recently, and the total debt to GDP ratio in the U.S. So adding up federal, state, and local, corporate and consumer debt, so housing as well, is now at around it was around 250% of GDP prior to this recession, and that was the highest level since World War II. So all of the issuance that you're talking about right here is pushing the debt level in the United States up towards an unseen level of nearly 300%.
Exactly. And, you know, we talk about the investment grade. Some of these companies are cash rich. Names like Amazon, Apple, they don't actually need the cash unless they're doing it for another reason. Are they looking to buy back their stock, keep paying their dividends with it? Or are they building a war chest to actually do more acquisitions? So what we're still noticing is that you're getting this connection between what the market is saying and looking at, which is you have good, strong companies and corporates. They don't have any issues with their debt. They don't think that the earnings can be a problem for these big companies. They're happy to finance these companies. Like, for example, Amazon financed themselves at 40 basis points, 0.4% for 3-year debt. That's nothing for them, really. You know, their dividends, they don't pay one, would normally be a lot higher than that, if possible. But if we go on to the next slide, and this is what James is talking about. Sorry, not this one, the next one, about the fact that there's no yield. We are in a low interest rate environment. If we look at the debt as percentage of GDP, this is just for the US government. We're seeing it increasing since 2009, the last crisis. We've actually doubled the debt as percentage of GDP, really. Now, each crisis, what we're seeing is the central banks doing the same things, cutting rates aggressively, pump liquidity in, DQE, buy as much debt as possible, encourage the government and allow the government to actually issue debt. Yeah. And what's quite remarkable is that once it's happening, you'd sort of normally expect to see the actual interest expense for the government increasing. But actually, in this crisis, it's actually been dropping. You've got to remember that their debt is rolling off and the new debt is just coming in on the short end of the curve, which for me does create concern. They have to keep rolling this debt or terming it out at some stage. But for them to do that and keep their interest expense manageable, the Fed has to keep, one, rates low, but also the yield market in control. So this comes back.
That's the problem we were talking about before. So if the back end of the curve is pushing higher, then the government can't afford to pay those rates. So the Fed is stuck. They have to push it down.
And this is the thing, it's at the moment, the market is thinking the Fed is focused on the short end of the curve.
Mm.
You know, this is why in the last couple of days, we've seen a bit of a yield move upwards, widening in the long end of the curve, causing a bit of steepening, but the short end hasn't really moved as much. There's this sort of implicit thought in the market already that we are getting some kind of yield curve control, especially in the short-term financing space. Mm. But as we know, things carry on. We'll end up with low rates for longer than people expect, but also we'd expect them to follow Japan's route. Japan, for example, has a yield target of around 0% for their 10-year bonds. You know, they're trying to fight inflation. They're trying to promote inflation. So they have to keep this yield down at 0% for 10 years. Maybe we'll see some kind of control like that coming in and a very flat curve in the future, manipulated by the Fed.
Yeah, so this is really the crux of the problem. I think the Fed's got an extremely challenging environment, and very few other central banks, maybe the BOJ, the ECB reluctantly, maybe the BOE, the Bank of England for a little while longer, had the advantages in the toolbox that the Fed has, but the central banks are the backstop for this economic recovery, and facing the funding constraints and requirements that you're describing, they have extremely little room for error.
Well, I think they've got no room for error, and the only response they've got, or policy tool they've got, is each time to basically be more aggressive. If you look at it, Japan has gone all the way, to buy equity ETFs for Japanese companies. The Fed hasn't gone down there yet, but they've gone down to buy IG and high yield ETFs. It's just the next stage for them, probably the next crisis. So this is why you have to be very selective. But unfortunately, within the fixed income market, my biggest problem is there's literally no yield for me to play with anywhere in the world. And you talk about those economies, those markets. Unfortunately, where can I get some yield? As a fixed income investor, if I'm a conservative portfolio, there's very little places for me. I have to extend my duration or to actually go down the credit curve.
We're dynamically going to change the course of the conversation because I'm going to throw one question at you.
Sure.
So one of the issues that we have from a portfolio construction perspective is when you're, traditionally when you're sitting on a 50-50 balanced and you kind of have half your portfolio in fixed income, then you traditionally, again, have an allocation to short dated, medium dated, long dated government, and then something in investment grade, maybe a little bit in high yield. Obviously, investment grade yields are a spread on government. So as we've had government bond yields getting lower and lower and lower, and therefore absolute investment grade bond yields getting lower and lower and lower. From a client's perspective, you're sat there and you either have to accept same level of risk, lower return on the fixed income front, or you have to start increasing the level of risk in order to maintain the same sort of level of expected return. Because even though the bond market yields are changing, it's not like that feeds through to client expected returns. So my question to you is, what can you do in the fixed income market to try and increase the level of yield that we can have in client portfolios without taking too much risk on at the same time?
Well, one of the first things is obviously looking at where the Fed is investing, because we know we effectively have a backstop. This is why, for example, instead of holding cash, we've gone to buying investment grade companies, which we consider to be strong, with this implicit yield curve control coming through. We're comfortable holding short dated debt, up to 18 months, maybe even 2 or 3 years now, I would say it's possible. That gives you a little bit of excess returns. In terms of government, you're going to be looking at the corporates, doing your analysis on the company and deciding, is that company actually stronger than some companies? When you start looking at their balance sheets, if something happens, will they survive? Whilst, we've got multinational companies like Apple, which I would say are a stronger balance sheet than some countries in the Eurozone, for example. We're looking at what measures the central banks, what are they buying as well? So, for example, in Europe, we've now got this, we have Italian bond yields rising before on the concerns of COVID and how much they're being impacted. But if we look at it, already this year, the ECB's bought 75% of the Italian government bonds issuance. Hey, that's a lot. But not just that, there's now a European fund being set up, which is about 750 billion to absorb even more. So every time there's a crisis, there's more being done by the central banks there. So anytime those offering an excess spread or excess yield, we look at it and we go, what is the risk? What is the reward here? Is it justifiable? Are they going to be helped out in some way? So I would say that going forward in the fixed income market, you have to be able to be, number one, looking for which issuers you like, do your homework on them, work out, am I comfortable holding the 5-year debt, 10-year debt here for that company? What is their ability to refinance their debt, their ability to actually service their debt, which I think is more important going forward than anything else. Personally, I don't really care about shareholders' returns. I care about their ability to repay me.
Mm-hmm. I think one of the overlapping themes that we're seeing between equities and fixed income is that we are moving into this stock picking, bond picking environment where you're trying to find specific issuers, particular issues where maybe there's a little bit of a fall between the cracks and we can find something that's priced a little bit cheap relative to either peers or the rest of the curve. I'm going to use that as a really not particularly subtle or eloquent segue into equities. From again, a portfolio management perspective, we have this unenviable task right now of deciding whether we would prefer to buy government bonds, which, as Adrian was saying, are priced incredibly low, or whether we would prefer to have some equities, which from a valuations perspective are priced very, very high. So we do have this decision of, if we're looking at US, UK, European, where government bond yields are going to contribute almost nothing from a nominal perspective, never mind from a real perspective. And then when we start looking at the equity markets, and this is when I'm going to let Misha jump in and take over, but in terms of, is now a good time to be buying equities, and what does the future hold? But before we hit that, Misha, I'll pass it over to you.
Yep. Hi, everyone. So let me start by pointing out that actually market performance was relatively concentrated, and it been led by a handful number of US IT stocks. And actually, if we look at the performance, year-to-date performance of the 5 largest US stocks, so they're staying up year-to-date around 18%, while S&P 500 actually flat. And if we look at the performance number for S&P 500, excluding these 5 stocks, actually it is negative. So the question now for us is actually to find out the reason why it's happening and what's going to happen next. So speaking about reasons why performance was so concentrated, is that actually these stocks is really liquid, and when investors was making their investment decision in the middle of March during the a period of extreme uncertainty, they wanted to be in really liquid instruments. So that is why if you want to get out, so you can do this relatively straightforward. So, and also in terms of earnings resilience, these stocks was reasonably good, and we was able to say even in March that actually they supposed to be hit, if any harm at all, relatively smaller, and impact should be relatively small compared to the other sectors. But now actually we seen that other industries, other sectors started to recover, and if we're looking at the so-called V-shaped recoveries, which sectors managed to recover, what we can use as a guideline for understanding what next stock we need to invest in our recovery basket. So we was looking at data, and lately we managed to find data which support our investment decision to invest in car manufacturers. And we was looking at China passenger vehicle sales, and now actually it managed to recover. For April, year on year, it stayed still negative for -5%, but it's huge improvement after previous 2 months. So it was -79% decline in February and -40% decline in March. So also we was looking at Apple mobile phone data regarding how consumer preferences with regards to means of transportation changed, and we noticed that actually now consumers started to prefer more personal transport rather than public transport, given that obviously they want to avoid risk to be infected. And we also was looking at chief of Volkswagen in China, and actually Volkswagen market leader in China, and he pointed out in his latest commentaries that actually they've seen first-time buyers which entering the market. So is this actually provide us some guideline how situation could be after lockdowns in Europe. And again, so it's something which we expect to be in Europe. Also interesting to point out US mortgage applications, and lately we've seen also almost V-shaped recovery, and we've been discussing internally what is going on in UK, and we with regards investment for UK investor visa portfolios, whether we need to invest in home builders here in UK, because from one hand we can see that mortgage rates relatively low, extremely low to be honest, but at the same time we obviously see harm from for personal income in terms of because of a lot of unemployment level really high, and we can't get idea when actually this should be this harm should be mitigated by low interest rate. So basically we decided to monitor UK property market, and we still thinking that this is the really leveraged towards economic recovery, and we need to monitor this more. Moving on, and I would like to point out the point which already mentioned by my colleagues, that actually if we looking at, on valuations, yes, it is expensive because of relative to history, literally any valuation metric staying expensive. So whether it is price earnings ratio, cyclically adjusted price to earnings ratio, or EV to EBITDA, yes, it's really expensive. But if we are looking at the relative game, so whether we need to invest in equities or in fixed income, I would say that choice actually very simple. So either we invest in investors invest in yielding relatively to nothing bonds from relatively low risk bonds, or high rating bonds from top issuers, or we invest in equities. But if we're looking at the relative expensiveness of equities, it's still staying equity minus fixed income yield gap is still staying near the top of the range. So meaning that actually we can expect that some cash flows will move from fixed income to equities, and that is why we can see for a while that liquidity will continue drives the expensive equities to be even more expensive. So yeah, I think that in this I can be joined by my colleague Simon, because he mentioned several times how difficult to build a balanced portfolio nowadays. Again, because very difficult to choose between expensive equity and yielding closer to nothing fixed income. So yeah,
it's I think one of the things that's hitting me, and trying to look at this from the perspective of the client, kind of is how I'm always trying to approach portfolio construction and financial markets. And normally from an equity perspective, I was talking with Michael earlier in terms of what sort of average amount are you prepared to pay upfront for current earnings? And if we're looking at that sort of price earnings ratio, historically for the S&P over the last 10 years, we're talking about 15. So you're prepared to pay $15 today per dollar of earnings, given the economic environment that we're sitting within. And for me right now, $15 feels a little rich, but unfortunately we're not at $15 anymore, we're at $22.50. So as we are poised to go into some sort of one of the largest recessions that we have had for many, many decades, and equity markets from a sort of valuations perspective are at multi-decade highs and at levels that have only previously been seen a few times, as James was mentioning at the beginning, over the last 140 years. how much do we want to buy equities right now, and how much should we buy equities right now? And even more importantly, how do we buy equities right now? Yeah, I mentioned before when I managed to gate crash the end of Adrian's presentation, the unenviable choice of, would you like 3 basis points for owning a 5-year gilt or 10 basis points for owning a 10-year gilt? I don't think you see many people chomping at the bit to add more gilts into the portfolio. The same concept for US Treasuries as well. Do you want 30 basis points or 60 basis points for a 5-year or a 10-year? And would you like to buy equities that are at a multi-year high or a multi-decade high? Because that's a lot of the options that we're currently faced with. So this idea of building a balanced portfolio is breaking down along with the concept of traditional asset classes. What we're looking at and what we're discussing increasingly is this idea of income generating assets and return generating assets, irrespective of the underlying asset class. Fixed income being safe and equities being risky isn't always the case. And part of my question to Adrian was a slightly leading question, because high yield is a part of the bond market where you can get higher returns and higher possible upside, but there's a lot of risk that gets baked into that. And you can own fixed income instruments that are more risky than the corresponding equities that you can buy in much safer, more defensive companies. So one of the questions that we're wrestling with right now is, how should we be constructing our portfolios from an asset class perspective, not just, as I said, for the next 2 to 3 months, for the next 2 to 5 years. And this is one of the things that we're looking at. Equity markets have rallied hugely over the last 2 to 3 months, as the macroeconomic data, as James has spoken through, has gone to some of the worst, not just the worst numbers seen, multiples of the previous worst numbers seen, as bond yields have gone from a developed market government perspective, negative from real yields across the board, across essentially all maturities. So which one of the whichever option you choose, you're going to be buying very low yielding, negative real yielding assets, or assets that are priced at some of the highest that they've been for many, many decades. So it's kind of an unenviable choice in that regards. So what we're going to spend the next 5-10 minutes or so before you can log off and relax, maybe you'll need a glass of wine or two after this, is what we've been doing and the reasons why. We've shown this chart before. We kind of kept it updating on an ongoing basis, and this kind of links into this idea of stock picking, bond picking, making sure that the exposure that you do have from an equity market is in companies that have business models that are what you can call COVID-19 compliant, companies that can continue to generate revenue over the next 2 to 5 years, whilst we're still coming out of this somewhat strangely locked up environment that we're all currently within. A lot of it is unknown. And when we're looking at this chart in front of us, we have all collectively gone through this for the first time together. All we can do is continue to act in the way that we consider the most appropriate from a positioning perspective and what we're buying. So we kind of showed you some of what we some of what we bought. We developed, and I'll skip back to this, our 2 coronavirus baskets, the resilient and the recovery. We've kind of taken you through the names. Our recovery basket is on, what are we on, Misha, version 3 now?
I think yeah. So basically, it's one of the few iterations which we get after just factor in the latest data-driven information. So because of obviously now we have more understanding about consumer preferences in the post-COVID-19 world.
So we're all the time continuing to assimilate data, and then that starts to adjust the holdings that we want to have. So when we skip back to this, we started to deploy the resilient basket about 2/3 of the way through March. We didn't quite hit the bottom of the S&P 500, and playing Monday morning quarterback in hindsight, if we'd gone in a little bit quicker, then performance would have been a little bit higher. But that's not a feasible argument because we have to deal with the situation as it was unfurling at the time as we were going through this. So we've slowly continued to build up exposure to companies that we're happy with from a resilient perspective. And now you can see in sort of end of May, as we started running into June, we started deploying into the recovery basket. So if I skip back to these are all fairly large blue chip, well-known stocks, and the performance of all of them, which we've not listed up there, has been phenomenal because they are all in their own ways, from our perspective, very well positioned to deal with the impacts of the virus, the changes that's happening on consumption and consumer behavior generally. And they've all been contributing and continuing to generate revenue. Now, the recovery basket is a very different dynamic. We've spoken previously about the resilient basket, so we're going to take a little bit more time to talk through the recovery basket. So now I've got the request for both James and Maxat to join me on screen as the new format. Look at that, perfectly timed, because we're going to move on to talking about oil and Total. I'm going to very casually exit stage right from a video front, but I've asked James to just talk through a little bit about the energy market because he's put out a couple of specific notes on this, and then Max will kind of seamlessly take that on to talk about some of the stocks that we've been building into the portfolios. So James, over to you.
Great, thank you, Simon. So I'm going to be very, very brief. The oil markets are currently working their way through what I expect to be a sequence of violent oscillations, so very sharp rallies with both flat price and the term structure going up pretty rapidly, and some pretty sharp sell-offs. So as we've written about over the past few months, the binding inventory constraint, tank tops basically, forced supply, which moves slowly, to ratchet sharply lower in order to meet demand, which can move very quickly. So in the very near term, the oil market has had to rebalance on the supply side of the equation, which is very, very painful. Now, where we are right now is, I think, a deficit market, and that's reflected both in the term structure and the level of prices. We may be pulling back in the very near term just for technical reasons, but I do expect prices to continue to push higher. Despite some talk of restarts in the shale patch, I think it's more likely that supply overall is going to be curtailed. Restarts will be curtailed as the inventory overhang and as Saudi threats to increase production further down the road keep marginal producers wary. I think what I'd like to sort of emphasize here is two things. First off, that winners in this kind of scenario are going to be those large and well-capitalized, technologically well-established players who have access to very attractive fields with good cost profiles. The second thing is that just over the past few days, the Saudis have announced that they want to try and manage the shape of the forward curve in the oil market in basically the same way that the U.S. Federal Reserve tries to manage the yield curve, which we spent a lot of time discussing earlier. So that's going to be, that's new. And that's going to be something which is going to add a really interesting dynamic and flavor to this market. So that's just a sort of an overview of the crude oil market. We expect it to be pushing higher into year end, but most of all, we expect a lot of volatility. And we think that people who are going to win are going to be those who have sort of robust capital positions and are sitting on really attractive fields. So over now to Max to give us a little bit more detail about Total.
Thank you, James. Good afternoon, everyone. So given everything James just told us about the oil market, we decided to find some opportunities within the industry. The first thing we decided to do is to limit our investment universe within the space, mostly to big companies with strong balance sheets, efficient operations, and we picked Total as best suited. The company has strongest growth in the industry from attractive low-cost projects, It has no exposure to OPEC plus members' cuts in production. And also a very important point is that if we look at Total's current dividend yield, it stays at around 8%. The company also mentioned that it should be sustainable if crude oil stays at around $40 per barrel, which right now Brent is trading, I think, at a level of 40.5. So if the price stays the same until year 2021, the current dividend payments should be sustainable. And then it just adds another attractive point if we compare this to what Misha previously talked about when we looked at equity dividend yields versus fixed income yields. There are also additional diversification benefits for the company from increasing exposure to liquefied natural gas projects. And also, if we look at it from an ESG point of view, the company has a target to achieve net zero carbon emissions by year 2050, which just adds another good point to its investment rationale. Now, if we go to the next slide, where we look at car manufacturers. So again, this is the industry that we identified as suitable for our recovery basket. So within the space, we also decided to look at major global car manufacturers, and we picked Peugeot and Volkswagen. So first of all, as Misha previously mentioned, consumer behavior is changing towards preference for private transport over public transport. We've also seen very strong government stimulus, which is creating tailwind for the demand in space. Also, early numbers from China suggest recovery for other regions. We actually just noticed a starting recovery in the US, a partial recovery, and we expect Europe should also join the trend. So the reason that we picked Peugeot and Volkswagen is that one, these two car manufacturers are the most efficient in Europe, and second is that they have very strong balance sheets. So if we look at Peugeot specifically, the company's operating margin for year 2019 stayed at approximately 6.2%, but this is for the group as a whole. And actually, if we look at core auto operating margin, I think it is actually close to 8%. While for Volkswagen, it's also around 6%. But then probably an even more important point, given the current situation, is company's leverage and balance sheet. So with Peugeot, the company actually has a net cash balance, whereas with VW, it's lower than the average of global major car manufacturers. So additional point for Peugeot is the company has reduced its cash costs and also increased liquidity. So right now, the overall liquidity for the company is around 24 billion euros, whereas monthly cash costs are less than 1 billion euros. So by rough calculations, the company, if everything stays the same, should have enough liquidity to run for another 2 years. And this is on top of the fact that the Peugeot's management is very capable, and its CEO is probably one of the best known in the space. And with Volkswagen, another potential catalyst can come from Germany government, which currently is discussing a scrappage plan. So this plan provides support for replacement of old cars with new ones, and this serves two purposes. So A, it stimulates demand, and B, it helps to meet ESG targets. So last time when this plan was introduced in 2009, it actually caused a 50% rebound in German car production and a subsequent surge in automakers and supplier stock prices. So if these plans go ahead, this will be another tailwind for the company and for the industry as a whole. And the third industry that we are looking at from a recovery perspective is entertainment, and within the entertainment space, we believe Disney is one of the strongest companies. So let me first talk about Disney Plus. So the company launched the service, I think, in autumn last year. It has experienced a very strong growth. So actually on the chart, you can see numbers for the previous 2 quarters and forecast for the next 2 quarters. And recently, I think end of May, management mentioned that they have already got almost 55 million registered Disney Plus subscribers. And this is in comparison to their initial guidance of 60 million to 90 million by year 2024. So the current consensus is that by the fiscal year end, which is September this year, they should comfortably reach their guidance, which is 4 years ahead of this initial schedule. And most of the growth should come from international markets, Disney Plus in March launched in the UK. It's currently rolling out in continental Europe and other regions. And this is actually, if you look closer, is not surprising given the exceptionally strong portfolio of intellectual property of Disney. It's the brand and characters of Disney are probably known by children across the globe. It has in its portfolio Walt Disney Studios, Marvel, Lucasfilm, which produced Star Wars. They bought 20th Century Fox Studios last year. Also, they bought Pixar in, I think, 2006. So again, if you look at the roster of characters, of animation, movies they produce, it's a very, very high quality asset. And then if we look at the parks, so this segment was probably the most affected by the pandemic and the lockdowns, but early signs are very encouraging. So right now, Disney has already reopened its park in Shanghai. And what's very interesting is that tickets for reopening day were sold out in 3 minutes with the standard price, so no discount. And it just shows the huge pent-up demand for theme parks. Also, Disney in Orlando, Florida, started to reopening in late May. And the overall question of parks reopening seems to be the question of when and not if. The current consensus for all US parks to reopen is in July, and US parks provide approximately 80% of revenue within the segment. Also, other segments are experiencing quite a strong growth overall over the long term, and within streaming space. So Disney Plus is not the only asset of Disney. They also have Hulu and ESPN Plus, which are also experiencing strong demand. So overall, we feel Disney has a very strong positioning for a recovery.
Perfect. Thanks, Max. If there are no additional questions, we've had a couple put in, which I think we've started to address. Some of these are quite tricky questions to answer in terms of, is there a bubble in financial markets? I think from that perspective, there is, and we're just trying to work out how to navigate safely through some of these volatile markets over the coming months. And in terms of a brief answer to what would make us buy more equity exposure, the big question from our perspective is how much longer is the Fed and central banks around the world, along with the cooperation of some of the governments, going to continue to promise essentially unlimited funds to markets, which have caused markets to rally higher. So we have taken a little bit more equity exposure as part of our core equity exposure, which we did in the last few days. But otherwise, we're very much continuing to stand on the sidelines and watch and wait. In the absence of any further questions, thank you all very much for joining, and hopefully we will see you at either the Impact webinar next week or the next monthly investments, along with one of the videos that we will be distributing very soon. Thank you very much, guys. Goodbye.